We'll give people a minute to trickle in here. Peter, I feel like I should have gotten my University of Texas diploma and put it back on my lovely Chrisman commentary house I have here.
Yeah, you need to add it to your virtual wall there.
No, nice to talk to a fellow Longhorn. Your offices are in Houston or where?
Well, we're headquartered in San Antonio. And then we have offices in Dallas and Houston. I'm in the Dallas office. So
nice.
Hence the Rangers paraphernalia in the background from our recent World Series win. So no Astros fans here.
There you go. Well, everybody that has joined so far, welcome to Mortgages with Millennials. I'm Robbie Chrisman. Kristin Messerli is my co-host. We're very pleased today to have Peter Idziak on. He is a attorney with Polunsky Beitel Green, and we're going to get into talking about some of the recent cases we've seen, rulings, how we think it'll play out going into the future. What's the impact on the housing market? We'll get into rates, talk about people that feel like maybe they've missed timing the market. We saw the 10-year treasury had a big drop today. Mortgage rates could be coming down, so maybe nobody missed timing the market. Kristin, what else are we going to talk about?
Whatever comes to our mind and whatever the audience wants to talk about, then we can pick this brilliant brain. Peter, so excited to have you on the show. And I think that we can see where the conversation takes us and go from there.
Yeah, Kristin and Robbie, happy to be here. And just, as a lawyer, have to give that initial disclosure that, my opinions and my statements on this program are my own and don't reflect any of the clients of Polunsky Beitel Green.
There you go. Well, you can go off on wild tangents then, and then with the disclaimer, you're covered, you're indemnified.
Well, at least in that regard, I just don't want to get fired, so we won't go too off the base.
Sounds good. What do you think is a good case to start with? The CFPB, NAR? What do you think is the timeliest thing right now that we should start with?
On the legal side, and from my background, I'm a regulatory attorney at Polunsky Beitel Green. We're a consumer finance and document preparation law firm based out of Texas. With we handle work nationwide. For me, it's the CFPB versus CFSA case, and that's the case that challenges the constitutionality of the manner in which the CFPB is funded. So the CFPB basically gets their appropriations not through the annual appropriations process, but through a request made to the Fed that must be granted, and it's for up to a specific percentage of the Fed's operating expenses budget. And that's been challenged as outside the normal appropriations process. And it was heard by the Supreme Court earlier this year. It was on appeal for the Fifth Circuit, and the Fifth Circuit had ruled that unique funding structure violated the appropriations clause and was therefore unconstitutional. And for those within the industry, the big takeaway there is that if the CFPB is declared unconstitutional, then what happens to all the rules that they promulgated using that unconstitutionally appropriated money? And at issue in the case was the payday lending rule, which would have set forth certain restrictions and requirements on payday lenders. So the Fifth Circuit, invalidated that rule based on the unconstitutionality of the funding, went up on appeal to the Supreme Court. They heard oral argument at the beginning of October. And it looks like it's going to come out, and from what I've heard and talking to other attorneys, 7-2-8-0, overturning the Fifth Circuit and holding that the CFPB funding is constitutional. And the court basically looked at the text of the Constitution, which says that for an appropriation, there just must be a purpose, a limit, and a source of funds. And although this is a bit unique in where the source is and the time limit, that it still fits within the text of the Constitution. So for anyone wondering, based on the Fifth Circuit, because a couple of months ago, there were a lot of conversations about where does this leave us? It looks like, based on oral argument, that the funding structure is going to be upheld. So for those in our industry, I'm sure all the compliance folks are saying, hey, until the Supreme Court rules, we're just going to keep doing what we've been doing. And it looks like that's going to continue.
I had thought that the Supreme Court might find a happy middle ground between the lower appellate court or the circuit courts there. But you're hearing 7-2 or 6-2, 8-0. Holy smokes.
Well, 8-1. I mean, part of the reason is that, the question was also, at oral argument and really in the briefing is, okay, let's say Supreme Court, you declare that the funding is unconstitutional. What happens next? Because the CFPB didn't only write a lot of its own rules, but it inherited rulemaking authority and established rules from other regulators. So, one trade organization, the Mortgage Bankers Association, filed an amicus brief basically telling the Supreme Court, hey, we're not taking a position either way, but we would just want to let you know that if you rule this unconstitutional, there's going to be chaos in the mortgage markets because no one's going to be sure what rules are still in effect and what aren't. So there's been a lot of rulemaking in the mortgage space, that what we refer to as TRID, or the know before you owe rule, which generated the loan estimate, the closing disclosure. Well, are we not using those anymore? Industry spent billions and billions of dollars implementing that system. The ability to repay rule that the CFPB passed, it included a safe harbor for lenders that meet certain requirements in evaluating a borrower's ability to repay. Does that go away? And are we left with the lower statutory standard? So it would be difficult for the court to find sort of, as you said, a happy median. And it'd also be difficult for the court to sort of either, between fully unconstitutional and constitutional, say, you know what, we don't like the way that this is funded, so we're going to rewrite the way the CFPB is funding, because then you're getting into, legislative action and, lawmaking, which is not really the Supreme Court's, role. So solutions such as that would be difficult to implement. The other thought was that the Supreme Court might declare it unconstitutional, but do what they did in a case in the 1970s that involved the Federal Election Commission and what's known as stay their mandate. So a decision doesn't actually become effective until the Supreme Court issues its mandate, and that normally happens soon after the decision is published. However, with the FEC case, they basically declared certain provisions of the FEC unconstitutional, but said, Congress, we're going to give you time to fix this. And in fact, it was a couple months. And in fact, the Supreme Court then extended that deadline to allow Congress to come up with a fix. There's was a thought, though, that, in this politicized climate of today, what would happen, if the Supreme Court actually did that? Would we get Congress to craft a solution? Or would you sort of have just a stalemate between Congress not doing anything and the Supreme Court having an opinion out there with a mandate that they've held, and how long would they hold it?
I wonder, does this embolden the CFPB? Because there's been some pushback against them. There's some cases that they've lost, and it's like, you would think that they would kind of tone it back a little bit. They're making enemies left and right. Obviously, they say we're out here to protect the consumer. Mm-hmm. But now that the Supreme Court is expected to rule this way, does this give them kind of like, hey, everything we've been doing is right, and we can keep pedal to the metal here?
Well, I mean, not really, because what it does is it takes away sort of what the thought is, like the last constitutional challenge to the structure of the CFPB. So the structural issues are thought to be settled after this. Again, this is assuming that the Supreme Court rules that the funding is constitutional. But the actual actions the CFPB takes, they have been very aggressive, and they really stretch their statutory authority in other areas. So, this case is really about how they're funded, but there's a lot of litigation that will continue about the actual rules that they've implemented based on statutes. There's been the resurgence of something called the major questions doctrine, which kind of first came up recently in a case. It was like West Virginia versus EPA, and it involved regulation of emissions of power plants. But and I'm going to not be perfectly on point with what the Supreme Court said here, but it's basically that if Congress hasn't spoken specifically to a major issue, then a regulator can't use sort of general language to extend that into a new arena. So there are a lot of areas where the CFPB has sort of taken a very aggressive or maximalist interpretation of a statute to increase its authority. And one of the areas that you'll see, and you've seen there's cases on this, is the definition of UDAP, which stands for unfair, deceptive, abusive acts or practices. And they have taken that definition and said, you know what, like, we're going to now say that UDAP includes discrimination. And so this was issued in an update to an examination manual. It was challenged in court, and the CFPB has lost, although it's potentially on appeal. And the issue there is that, look, like, there are other statutes out there. There's a COA, there's the Fair Housing Act that specifically deal with, discrimination based on race, national origin, other characteristics of the borrower or applicant. And you can't take this general, statute and statutory grant that has nothing to do in its statement with discrimination and apply it to discrimination. So I think you'll see the CFPB continue to be aggressive, not as aggressive as they have been, because they are losing on a lot of these lawsuits. But under Rohit Chopra, the current director, the CFPB doesn't seem to be, cowed by that. They lose in court, and then, they issue another policy on something else that is similarly, maximalist from the industry perspective. From their perspective, it's doing the most to protect consumers. And if industry wants to challenge it, hey, go right ahead. We'll see you in court. Seems to be their attitude.
So I have a utopian question here. If you had unilateral power to rewrite regulation or the CFPB's mandate, what do you think is an ideal way for the CFPB to operate or regulation in the mortgage industry? Do we need more? Do we need more streamlined? Where does your head go?
Well, I would say that one of the big differences and one of the more unique aspects under Rohit Chopra is that the CFPB doesn't engage in rulemaking anymore, because that's an expensive process. It takes time. You have to write the rule, you have to analyze the impacts, you have to, issue the initial rule, receive comments from stakeholders and the general public, and then issue a final rule. It all takes time. And then it's immediately subject to attack. So what the CFPB has done under Rohit Chopra is, you see a lot of things through, like, changes to an examination manual or policy statements, or what we call regulation through enforcement, where, they find some lender or financial services provider that they believe is engaged in conduct that, is not clearly in violation of any rule or statute, and get a consent order out of that company, publish the consent order. And for the rest of industry, you're sort of on notice that the CFPB takes the position that, this practice or act is illegal or violates a regulation. And so, based on sort of the risk aversion in the mortgage industry, you implement that into your compliance system. But, when did anyone ever have a chance to, realize that this was the CFPB's position or interpretation? When did anyone the stakeholders have an opportunity to comment on this? So it's sort of, in my, utopian world, at the very least, the CFPB would go back and follow the Administrative Procedures Act in issuing these rules. And the other thing I would say is that, from an industry standpoint, is that do a better analysis of the costs of implementation to industry, which then gets passed on to borrowers and other consumers, versus the benefits. We had this, as I mentioned earlier, the know before you owe rule with the loan estimate and the clothing disclosure. And the CFPB did a study, and I think it was in 2020 or 2021, that said, we think there's been some improvement in consumer understanding, and overall it's been beneficial, but not much. So, and I understand that, you have to try it first, I guess. But in a lot of areas, it just seems that they're writing rules without really looking into, and because it's not part of their mandate, accounting for the cost to industry.
One of the problems that I think we're seeing now with the rapid growth of technology and social media and that kind of thing is like, I would imagine it's really hard to stay up with what's needed there from a regulatory perspective, and so you see like banks and lenders just on all ends of the spectrum around how they're trying to protect themselves. And we saw I don't know how much of this was digital redlining, and you probably know a lot better, but the CFPB, was it, reported 23 major violations around redlining and discrimination practices last year, which I think was an uptick. So I am curious if how we're seeing redlining fit into, or digital redlining specifically fit into that, because it's a little bit more vague, it seems like, and difficult to to work around, or if it's falling into line with some of the things you're talking around, where it's just you're getting a consent order or these types of things to see what's right and what's wrong right now, and how do we stay up to date with some of those issues as well?
It is tough, and redlining and digital redlining have been a big concern of the CFPB. And what is interesting, Rohit Chopra is a young, in terms of age, for someone who's the director of an agency. He's in his early 40s, so you might think, well, he'd be very pro technology and see the fact that it can level the playing field, reduce costs for consumers, take the human element out of this. But he's sort of taken the other tack that he sees technology as potentially dangerous, in that it can make it, easier and sort of more invidious for technology to discriminate or on individuals based on a prohibited basis, or take advantage of them. There's a term that's thrown around by the FTC and CFPB called dark patterns, which is basically a way in a digital environment to hide or obscure information, or to entice consumers to make choices they wouldn't otherwise have made. In underwriting, and this goes along with the digital redlining, a lot of individuals and in a lot of companies in the financial services are now using AI and machine learning and algorithms to approve or deny applicants. And some of those, are black boxes. And so the CFPB has said, if you deny credit to someone based on the results of an algorithm, you need to be able to explain to them, as required by the Equal Credit Opportunity Act, the reason for the denial. And, just saying, well, our algorithm said no is not enough. And going along with that, it's, how is your algorithm programmed? What data set was it fed? How do you know that your algorithm isn't, especially if it's a learning algorithm, AI, how do you know that it isn't taking in information that is either, a prohibited basis or a proxy for a prohibited basis, and making a decision on that? There are kind of anecdotal stories of, algorithms making, denying credit to plumbers. Because the data set that it was fed, it had a higher delinquency rate for individual borrowers whose occupations were plumbers. And the lender, took a little while to figure that out, because it wasn't always clear to them, and this is, anecdotal, that this was happening. So how do you know that your algorithm isn't sort of taking in information, making a decision based on it, and using prohibited information that's a prohibited basis? And with the digital redlining, I think for millennial borrowers, it can be especially a concern, because they're both more sophisticated technologically, but probably less sophisticated financially than older borrowers. So there is that risk that, products that are geared towards millennials could be seen as, taking advantage of this lack of knowledge. And that's where it can be kind of difficult, because you do want to target millennials, where they are, TikTok, online, social media, but at the same time, you do have to make sure that you're doing it in a compliant way.
Mm-hmm. Yeah. We had a question from Ashley: is DU and LP considered an algorithm that's becoming an issue?
So this is what's a little bit special about the mortgage industry, is that, a lot of times you are using, an algorithm that is not your own. It was developed by Fannie and Freddie. So my own opinion is that lenders are a bit safe there, because you're relying on Fannie and Freddie, and not your own kind of bespoke product. But I have no great insight here, but I could see it becoming a problem, or more, I don't want to say problem, but an issue that gets raised later on, that as it gets more complicated, that what are we as the lenders receiving back, and how do we know that DU and LP are operating in a compliant manner? Because a lot of people in the industry know that you have obligations to oversee your vendors, and we don't really think of Fannie and Freddie as a vendor, but you're still using their product and their service for your borrowers, your applicants at that point. And where's your liability if it turns out that that something went wrong and there was something else? I think that in that situation, you probably not face a lot of direct risk, but it is an issue that at least on my side of the industry, we think about a little bit. That so the counter argument too is always, well, there's no rule that says you have to use DU or LP. There's no rule that says if you originate a loan that you have to sell it to Fannie or Freddie. But because these are GSEs, I think, I don't want to say there's special rules, but I think there's separate considerations that come into play there.
2023 has been dominated by talk of AI and machine learning, and obviously it evolves so rapidly. You mentioned companies are responsible for overseeing their vendors. As AI moves forward, and yeah, in the mainstream press, there's these doomsday things of, oh, is AI out to hurt us? That sort of thing. But in the mortgage industry, where do you think the responsibility should fall for managing AI? Is it on the regulation? Is it on companies? Is it on their vendors? Like, how do you see that playing out?
Well, I think, not just the CFPB, but certain state regulators have been, they're not seeking to shut it down immediately. They are aware that this is entering the market, that it will be there. And certain states have created what they call sandboxes for small lenders or other financial services providers to sort of, test out their new products and see how they function. So I think regulation will have a part to play here. But you're right, regulation is lagging, and AI is it's fast. And what we're seeing now through the CFPB is more of a push right now to regulate large technology providers. They recently issued notice that they intend to look more closely at large payment processors and payment wallet providers like Google Wallet, Apple Pay, that kind of thing. So in the fintech world, the mantra is kind of like move fast and break things. In the mortgage world, it's kind of move slowly. So if you are hiring like a financial startup to provide you a service, these may be folks that have never operated in a regulatory environment, that maybe find regulations inhibit progress in their opinion. So as a lender, you are responsible for understanding the product you're buying in a certain way, and understanding how it works, and having your vendor explain to you, like show you and demonstrate for you how the algorithm works, like where the data comes from, how it's processed and analyzed. And you, in a perfect world, you could know everything about it. And with this actual technology, a lot of it's proprietary. You're not going to see that. But from a lender standpoint, you do have to make a good faith effort to understand and investigate and confirm that your vendor is compliant. You can't just take their word for it. Although of course any good agreement would have reps and warranties in there that they are compliant with all federal and state regulations.
You hit on actually a really good point. I talk to a lot of people on my podcast. It runs 5 days a week, and as important as an algorithm might be, data integrity is as important. Whatever you're feeding it, it's like if you're feeding it that plumbers are going to default more frequently, like that's not the algorithm's fault when it spits out whatever. Data is so important for companies to stay on top of. You agree?
Oh, definitely. Not just on the regulatory and compliance side, but your data can be a valuable source of information about your borrowers, about your prospective applicants, about how you advertise, about how you allocate funds. But data integrity, to your point, very important, especially now that we've started to see an uptick in mortgage fraud. It's still low by historical standards, but with sort of the ability to modify bank statements, and we've seen quite a few of these where applicants have falsified their bank records or falsified other business records in order to get a loan. And from that standpoint, verification of data that you receive from a borrower is also important in the underwriting process to make sure that you are verifying that. And if you are, I honestly don't know of any specific lender that has created their own, AI underwriting model that is fully automated at this point. I'm sure someone's out there that's doing it. I'm not aware of that. But to the extent you get to that point, that's where you really need to make sure that, whatever data it's collecting and analyzing is from validated sources, because you get a corrupt data source and it can corrupt everything. The other thing would be that, a big thing, and we saw with recent breaches, data security is hugely important in this environment. So investing in IT, not just for the data analysis side, but for your data protection is huge. It's a daily concern of everyone in this industry, I think.
It's interesting because a lot of the hesitation I hear from millennials wanting to enter the market is that they're concerned they're going to be sold on something they can't afford, or they're going to, they like, in fact, one of the questions we asked in a recent financial literacy report, a study we did asking questions about their homebuyer literacy or understanding of buying a home. And one of the questions was whether their income was validated or verified whenever buying a home. And I can't remember the percentage, but it was a good portion of people didn't know that. And I think, in talking to people, a lot of people want to know that there is some regulation around this. Like they want to know that there's not going to be, there's a lot of fear around another 2008 financial crisis. There's a lot of, and so I actually think while there's a pushback around, and necessarily around some of the, the regulatory burden on companies, I feel like from a millennial perspective, some of this should be advertised a bit more on like, this is what we're doing, any thoughts on that?
I think the mortgage industry is fundamentally different. I think for a lot of millennials, and I think I'm just outside that or an elder millennial, but 2008, is formative experience for a lot of millennials in this country. Either they were young adults just starting their college career, or they were with their parents and they saw the devastating effects on that. So it does make you risk averse and worried that, what happened in 2008 could happen again. The big change was, of course, the CFPB at the federal level. It was an agency designed solely to, as its name, protect consumers. Whereas previously regulators that had regulated financial institutions had other concerns. They were more concerned with like safety and soundness of the banking system than they were in protecting consumers. And I think that, in my mind, despite, or, there are two ways to think about the ability to repay rule. One is that it's sort of, counterintuitive that you would have a lender be the one that determines whether the borrower has the ability to repay the loan based on its own terms. Doesn't the consumer know what they can afford, better? But the practical reality is, and to your point, Kristin, a lot of folks, they don't know. They maybe don't have that financial literacy. And it was, for better or worse, a decision that, well, if a borrower doesn't understand the terms of the loan, doesn't know if they can repay it, we'll put that on the lender. So there is, a requirement out there. And, if you're a loan officer, you can maybe explain, how debt to income is calculated, what the limits are. But the big thing is, we're going from an environment pre-2008 where you had a lot of variable rate loans, and you had a lot of teaser rates. So you had, the first couple of years, you would have a below market rate that would reset, but don't worry, you can always refinance before that happens. Today, the vast majority of loans that are originated are 30-year fixed. So your payment is going to be the same, for the next 30 years if you never refinance it. So you have that sort of security. And in fact, like debt is in a sense a hedge against inflation. You're making that $3,000 monthly payment. Today you're going to make that $3,000 monthly payment in 2056, and those dollars are going to be worth a lot less. So I think, that's something that's maybe not that well understood either, that, even with rates elevated, that a fixed rate debt, is not necessarily like something that you shouldn't expect to be able to afford if, you're young and starting out your career and you can afford it now. There's always job loss and things you can't account for. But the odds are very good that you're going to be able to pay it. And what we've seen now is mortgage delinquencies are at historic lows. And there's been sort of, I think, a sea change in the way we view foreclosures in this country, for good or for ill from a lender's standpoint. But there are so many mitigation options, workout options. The goal, it seems, not necessarily stated amongst federal regulators, that if someone's in a home, we're going to do everything we can to keep them in that home before foreclosing. And there are a lot more options, that would protect a borrower and assist them in remaining in their home should they suffer a job loss and not be able to afford it. But today, the lenders are doing that. They are verifying income. They're analyzing your debts. They're looking at your debt to income ratios, and that's something that didn't happen as programmatically in 2008. And that's something that I don't think a lot of people outside the industry really know.
Yeah. Absolutely not. I mean, it is really interesting. And I've consulted for a few vendors not coming from the industry, but entering the industry. And they, as you said before, they don't have the knowledge around the regulatory environment. And to them, it's like, oh, this is a fresh perspective, which is nice. But also it's like, there's so much going on here. And I actually think it's to the consumer's detriment that we don't know at least a window into what's going on behind the scenes from a regulatory perspective. And I think it's interesting how much this mirrors what you said before, from a tech perspective and regulatory perspective. We've shifted from the bank or financial institution or lender being the center of the transaction to the consumer being the center of the transaction. And that's how, customer or user experience and all of that is being designed around that. And it's really reflected in our regulatory environment too. So I think that's really interesting.
Kristin, sorry, Peter, go ahead.
Oh, and just on another point, for 2008 is that I think for millennials that are maybe sitting on the sidelines thinking that you're going to, well, we've seen home prices run up a lot over the last 4 years. Like, I'm going to wait for, the inevitable correction. That I think might be sort of like a false lesson learned from 2008 that you're going to see a crash. We don't have the oversupply of housing that we had in 2008. If anything, we're supply constrained in this country. Boomers living longer, the sort of golden handcuffs of a sub-3 rate that I would not expect, based on talking to folks in the industry, builder clients and other folks, that you see that. And there's some thinking that, we might have already seen a correction in a lot of areas, a lot of the major metros that occurred, from, I think it was like July 2021 to now. You've seen prices to drop about 10%, I think, in certain areas. So that might be done, especially if rates, start trending lower again. So, to Robbie, your earlier point, and I see a comment there about the tax and insurance, like, yeah, that'll definitely increase on a 30-year. But back to your point, Robbie, it timing the market, if you're able to, like, maybe now's the time. I mean, I don't have a crystal ball on this, but I have been in the industry, since 2008. I actually started working on Wall Street in corporate bankruptcy, so saw a lot of the fallout of 2008 through that lens. That it feels a lot different this time. So I wouldn't necessarily expect home prices to drop significantly any further.
I think it's becoming very metro dependent, much more so than it used to be. And we brought up a good point about millennials living through the Great Recession. I've heard stories about my grandpa living through the Great Depression in San Francisco, selling newspapers for a nickel. He stashed money under his mattress the rest of his life. And so I was going to say to Kristin, how do you think that this has impacted millennials in their home buying? My mind immediately went to, everyone feels like they can get rich quick. Look at like crypto. It's like, oh, I should be able to double my money in 3 months. Oh, it's like, it's created this like boom, like very volatile investing type of mindset in the younger generation. Kristin, you agree with that?
Totally agree. That's so true. I didn't think about how much, and yeah, coming into crypto and the NFTs and all of that, there's just been this big, like you invest and you get this big return really quickly. And yeah, it makes sense that we've entered adulthood kind of during or after the financial crisis. That's kind of what we're expecting from housing. Instead of this, we're betting against inflation. We're seeing, the longer term investment.
Yeah. Well put. So Peter, before the show closes, and we have just under 10 minutes here, I do want to talk about NAR. And I had said to you before we came on the air, it would be nice to talk about how NAR, it's getting hit from all sides. You had told me it's the largest lobbying body in the nation, or spends the most money. It's getting hit from all sides here. What's the future of NAR, and where does that lead to with potentially the future of home buying? What are your thoughts?
As we talked about before, you've seen commissions, and I think there is sort of a misconception, especially maybe among millennials, but I think the general public, that commission, realtor commission is 6%. That's what it is. Folks might think it's set by statute or something like that. Technically it is negotiable, but this is sort of the crux of these lawsuits, is that as a practical matter, if you're the seller, you have to pay the selling broker 5 to 6%. And then that selling broker, in order to list on MLS, has to agree to make a standard offer of compensation to the buyer's agent, which is normally going to be a split of that. So, 2.5 to 3. And if you want to sell your home on MLS, and if you want, buyer's agents to bring their buyers, like, this is what you have to do. And that's what this lawsuit really challenged. And there's several. The most recent, the Missouri, with the $1.8 billion settlement, was really the heart of that this is anti-competitive behavior. It's an antitrust violation. And I think, as an outside observer, like, there's a lot of merit to that. You see that, in effect, like, they have this, NAR has and their associated realtors has a stranglehold on real estate listings. And so you have sort of a tidal wave of cases. You have this one, you have several more filed in other states. Recently, one in South Carolina filed by buyers, sort of alleging antitrust violations on the buyer's agent side. So although I know anecdotally that a lot of the major brokerages have sort of said for right now, like, it's business as usual, that there has to be a reevaluation coming about this. And, not just in terms of how commissions are paid. So you may see movement towards a requirement that, or a practice where the buyer pays the buyer's agent. But also in the amounts of compensation as well, that gets reduced. One of the big arguments is sort of that, well, why is your commission rate stayed the same when you do basically the same work you did a few years ago, but you're making a lot more money because the value of home prices have increased something like 40% over the last 3 or 4 years. So there's sort of this, economic argument about it. I think from the mortgage industry standpoint, what'll be sort of an interesting problem for us is that, the way that commissions are paid now by the seller is that it takes it entirely out of the buyer side of the CD. So if you have buyers now that are responsible for paying their own buyer's agent, and they need to be able to finance that, how does that work? Or if you have a seller that's going to agree to, as part of a concession, pay the buyer's agent, well, there are interested party contribution limits. Like, do those need to be raised? How does that need to be looked at? The entire system is sort of predicated on the idea that, the seller pays both agents. And without that, it's going to require, from our side, a big rewrite. Now, do I think that it affects home prices generally? Not really. Even though, if you think about it from a money flow kind of way, the buyer is sort of really paying, both agents, because buyer pays the purchase price. From that purchase price, the agents are paid, and then the seller retains their sales proceeds. So would home prices decrease based on that? I mean, maybe, but if so, we're talking 1 or 2%. But I do think, you're going to see now that there's sort of weakness been shown here, that NAR is going to continue to get hit with these lawsuits. And you do have DOJ that has been, an active, not participant, but actively watching these lawsuits. And over the last few years has entered into several, agreements with NAR, and you could see more action on that. But I would think, from talking to realtors, that they expect that commission rates may decrease slightly, but they don't see, a wholesale change to their business. Now, whether an outside observer might disagree with that, I don't think I'm enough of an expert to say.
So the Missouri lawsuit was the big one that stole headlines these last couple of weeks.
Mhm.
What else is imminently on the horizon for NAR? What else are they facing?
There's a lawsuit in Illinois. They're all basically the same thing. And they covered, specific classes of home sellers. So you're going to basically see the same arguments. There are some distinctions in different metro areas and different MLSs as to the requirements that listing service has for compensation offers and such. So you will see some changes. But I would say that, that NAR as an entity, they are not that deep money-wise. I mean, for a lobbying organization, they have something I heard the other day, and don't quote me on this, but about $100 million in assets, which that can get depleted very quickly. So as a lobbying group and as a requirement that real estate agents join the national NAR or their local and become the realtor that we know, you may see that fracture, and you may see brokerages come up with their own system. That's just sort of a guess of what's happened in some other industries, is that people still want like standardized listings. And one of the arguments that NAR makes is that MLS is a way to ensure that the information that's posted on it is verified. So that's why we only let our members post. And one of the arguments they made at trial was that, well, Zillow and Redfin are great, but that's all unverified information. So it actually makes the use of an agent even more important, because you need someone out there who can help you through the process. I don't know, realtors and real estate agents are a mixed bag, like any profession. And you'll talk to folks, I'm sure you guys do, that, they love their realtor. They think they were worth every penny they paid. They'd be happy. They were happy with the experience. And then you have others that think, well, I did all the work here, and so are we going to see real estate agents maybe offer different tiers of pricing for different services? That's probably one likely avenue, that we will agree to do this for you, just like list it on MLS, post the photographs and answer questions, versus sort of like a bespoke or full service brokerage that says we will do all this and more, and so charge you a higher commission rate.
Yes, as a buyer, I think my real estate agent was worth every 0 penny that I paid them. We're out of time. Kristin, any closing remarks from you?
There's so much more we could talk about.
No, Peter, come back.
Yeah,
I'd be happy to. This is fun. No, I saw a question about predictions of the appeal. I mean, that's tough to say. The jury was unanimous on this. I don't think, as an outside observer, that there were any sort of procedural issues that were flawed in the original trial, where the appellate court might just reverse and remand for the trial court to sort of fix whatever errors there were. You may see out of this like an appeal and then a settlement from some of the other players that hadn't settled yet. For NAR, that's a little bit more difficult, because to them, this is sort of their whole reason for being. So if it's settled in a way that does away with the lobbying industry, the lobbying trade group, like that would be very problematic for them. So you may see, and you did see some brokerages already settle. You may see sort of a split in incentives there that lead to different outcomes from different parties.
Well, thank you so much for taking the time to go through each of these questions and really interesting areas of study. So thanks to our audience for chiming in here. And we look forward to continuing conversations in the future. Robbie, any last words?
Peter, you're awesome. I really appreciate you coming on and talking to people about this. I thought it was a great discussion.
My pleasure. I hope the information was helpful.
Absolutely.
And happy to come back.
Thanks,
Awesome.
everybody. Bye.